In prior videos, we looked at fringe benefits, cafeteria plans, and the valuation of fringe benefits. In this video, we'll take a closer look at what happens when these fringe benefits are deducted as either pre-tax or post-tax. We'll talk about common pre-tax and post-tax deductions and what exactly is different on a payroll check when pre-tax deductions are deducted. Pre-tax deductions are voluntary deductions that are withheld from an employee's gross pay before any tax withholdings are calculated. That means that these deductions reduce the taxable income of the employee. Pre-tax deductions are voluntary deductions that the federal government decided are eligible for pre-tax withholding status. That includes certain types of insurance, retirement plans, and cafeteria plans. One common pre-tax deduction is health insurance. It's common for employer and employees to share the cost of health insurance. Your employer may pay 80% of every employee's insurance premium, and the employee pays 20%. Or sometimes the employer pays 100% of the employee's health insurance premium and a certain percentage of the family health insurance premiums. It is up to the employer, but it is an important consideration when accepting a new position. Several companies I worked for paid 100% of the entire family health insurance premium, which is very generous, whereas others only pay 50% of the employee's cost of the health insurance, and the employee pays 100% to cover their family. Regardless of how much or how little the employee has to pay for employer-provided health insurance, it is a nice tax benefit when the premiums that the employee pays for can be deducted as pre-tax. Think of it this way. Yes, you have to pay part of the cost, but the government helps you pay for it by lowering the taxes that you would have otherwise paid. To qualify for pre-tax status, the insurance plan must meet the following IRS requirements. The health plan must be offered through the state's small or large group market. It can be an employer's self-insured health plan or the DoD's non-appropriated fund health benefits program, a governmental plan, a COBRA health coverage, or retiree health coverage. In addition, in 2010, the Affordable Care Act was passed, providing small businesses a tax credit for providing health insurance coverage when their employees are at low or moderate income levels. The Act extended coverage of children until the age of 26 to be included as an option to employees on a pre-tax basis. In addition to these rules, the payroll accountant must also be aware of the reporting requirements for employees' health insurance programs. Sometimes employers are offering additional health and disability insurance coverage that is entirely paid by the employee. One of the largest providers of this type of insurance is Aflac. Long-term disability is excluded from taxable income under the IRS Revision Ruling 2004-55. If an employer pays for long-term disability insurance, these amounts may be excluded or included in gross pay, depending upon the election of the company. When determining the tax treatment for the supplemental health insurance, the IRS guidance provides the following. If the income derived will be estimated to be tax-free, then the costs associated will also be tax-exempt. However, supplemental health and disability plan premiums are not tax-exempt for Social Security and Medicare taxes. What about retirement plans? Retirement plans have two different types, defined benefit and defined contribution. A defined benefit plan means that the employee will receive a certain amount each period after they retire, whereas defined contribution plans differ in that the employee contribution is a set amount, usually a percentage or a fixed amount per pay period. In a defined contribution plan, the amount received by the employee after they retire varies. Some examples are 401k, 403b, SEP, ESOP, Simple 401k, IRA, and Simple IRA. It is up to the employer to decide if they will offer a retirement plan and which type is best suited for their firm. The 2024 contribution limits for 401k are $23,000 plus $7,500 for people over 50. For 2025, the contribution increased to $23,500 with the same $7,500 catch-up contribution for people over 50. There's a new catch-up contribution for those that are between the ages of 60 and 63 of $11,250. In this example, the employee earns $25 per hour and is paid weekly. If you work 45 hours, which includes 5 hours overtime and has a 4% 401k deduction and $45 withheld for the cafeteria plan. Our task is to calculate her taxable income subject to federal income tax and FICA. We start by calculating her regular wages by multiplying 40 hours times $25, which is $1,000. To that, we add the 5 hours of overtime at $37.50 per hour or $187.50 for total gross wages of $1,187.50. Step 2 is to calculate the pre-tax deductions. The 401k deduction is a percentage, which means we have to multiply the gross wages by the percentage to figure out the dollar amount. So $1,187.50 times 4%, which is $47.50. The cafeteria plan deduction is a fixed amount per week of $45. In step 3, we calculate the taxable income for federal and state taxes. For federal and state taxable income, we can reduce the gross wages by all pre-tax deductions. In our case, $92.50, which is $1,095. That means that when we calculate the federal and state taxes for this employee, we will look up $1,095 as taxable income in the federal and state taxable tables. In addition, on the Form W-2 at year end, the wages listed will be the taxable wages after deducting the pre-tax deductions. So for Jeanette, if this was the only paycheck she earned from this company, her Form W-2 would show in box 1 wages, tips, and other compensation of $1,095. In step 4, we calculate the taxable income for FICA wages. And it's important that you're aware that not all pre-tax deductions reduce gross wages to calculate FICA taxable wages. Pre-tax deductions that are not allowed to reduce gross wages to calculate FICA taxable wages are retirement plan contributions such as 401k, adoption assistance, and life insurance premiums for coverage above $50,000. So in our case, that means that we can only deduct the pre-tax deduction for the cafeteria plan of $45 per pay period, but not the 401k contribution. That means that the FICA taxable income is $1,142.50. So for Jeanette, if this was the only paycheck she earned from this company, her Form W-2 would show in box 3, Social Security wages, and box 5, Medicare wages of $1,142.50. Here's another example. Andia earns $98,000 annually and is paid biweekly. As a pre-tax deduction, she has 10% withheld for the 401k and $5,000 per year withheld for the child care FSA and $3,200 per year for the medical FSA. Calculate her taxable income subject to federal income tax and FICA. So in this case, we first need to divide the annual salary of $98,000 by 26 to arrive at the biweekly wages of $3,769.23. The next step consists of calculating the pre-tax deductions. First, the 401k, which is 10% of gross wages for $376.92. Then we divide the annual child care FSA by 26, and then the medical FSA by 26 to arrive at the biweekly amount of $315.39. The total pre-tax deductions are $692.31, which are all deductible from the gross wages to arrive at the federal and state taxable wages of $3,076.92. That is the amount that you'd use to look up the federal and state taxes in the tax tables. In step 4, we calculate the FICA taxable wages by deducting only the FSA pre-tax deductions, but not the 401k deductions, to arrive at $3,453.84. Now that we covered pre-tax deductions and how you calculate federal and state taxable wages and FICA taxable wages, let's look at post-tax deductions. Post-tax deductions are deducted from the employee's pay after federal, state, and local income taxes and FICA taxes have been calculated and deducted. Now, it's important to know that post-tax deductions can be both voluntary deductions, but also court-mandated deductions. In other words, sometimes these deductions are up to you to pick, whereas other times a court will do so for you. Voluntary post-tax deductions are, for example, donations, union dues, supplemental insurance, whereas court-mandated deductions include garnishments, tax liens, and child support. The voluntary post-tax deductions are pretty straightforward, right? These are deductions that you signed up for with your employer. So let's talk next about court-mandated deductions. One of the basic rules is that court-mandated deductions cannot take away the employee's entire paycheck. The Consumer Protection Act has specific guidelines about how much of an employee's pay may be deducted for each class of garnishment. Garnishments may not be more than 25% of the employee's disposable earnings, or the amount by which an employee's disposable earnings are greater than 30 times the federal minimum wage of $217.50. In case you're wondering, disposable income is calculated by taking the gross wage of the employee and deducting all mandatory tax withholdings. One common court-mandated deduction is child support payments. When there are court-mandated child support payments that must be withheld from an employee's paycheck, the deduction may be up to 50% of disposable income if the employee is supporting more than one spouse or child, or 60% if the employee is not supporting another child or spouse. There is an additional 5% for any child support that is more than 12 weeks in arrears, meaning past due. There are other court-mandated deductions, such as liens and other garnishments. The maximum amount that can be withheld from an employee's paycheck depends on the type of debt the employee has. U.S. government debts and student loans have the same maximum amount to be withheld from the employee's paycheck. 15% of the earnings in excess of federal minimum wage weekly earnings. Consumer credit loans have a limit of 25% of the earnings in excess of federal minimum wage weekly earnings. For personal bankruptcy, the amount to withhold from the employee's paycheck is the lower of 25%, or 30 times the amount of weekly income in excess of federal minimum wage. For tax levies, see IRS publication 1494, which tells you how much of an employee's paycheck is exempt from levies based on the number of the dependents the employee has. Here's an example of a paycheck with both pre-tax and post-tax deductions. I'm using the same example of the employee and DIA we talked about when we discussed pre-tax deductions. The layout or design of the paycheck looks different from employer to employer, but it should contain the same information as what you see here. At the top of the paycheck is the employer name and address, and sometimes also the employer tax ID number. Next, we have the employee name and address and employee ID, as well as filing status and additional tax information. The earnings section shows us the gross pay for the current period and year to date. Next are the pre-tax deductions for 401k and FSA of $692.31, followed by the tax deductions. In this section, you can see that the federal taxable wages are $3,076.92, which is the gross pay minus the pre-tax deductions. The FICA taxable wages are $3,453.84, which is the gross pay minus the FSA pre-tax deductions. The next section is the post-tax deductions section, where this employee has a charitable contribution for United Way, union dues, and supplemental insurance deducted for a total of $184. The net pay of $2,416.70 is the gross pay minus pre-tax deductions of $692.31, minus tax deductions of $476.22, and post-tax deductions of $184. That's it for this video on pre- and post-tax deductions, and I hope it helped you understand the concept.